Hello, everybody, and welcome to episode 18 of the Financial Time Travelers podcast. This is called Correlation Chaos. Everybody's going crazy. I don't got my bars. It's all good.
Hey, Doc, you better back up. We don't have enough road to get up to 88.
Roads? Where we're going, we don't need roads.
All right, everybody, let's get right into the nitty-gritty. Let's get into the real stuff, the stuff that everybody wants to talk about, why we have notifications going on in the background, because it's chaotic in the background, because there's a lot of correlation that is disconnecting in the markets. You've probably read about it on the blog. We've mentioned it a few times, but what we're discussing here is that there are three major indices that previously, or indexes, that have been kind of flowing together on the charts and very tight correlation. You see on this first graph, as soon as November 8th happened, they started to take off on different trajectories. Think about three different planes, one being, a little two-person, one being a six-person, maybe a Learjet, and the third one being a 747, and they're all going in different all altitudes out into the universe and into space. And what we're seeing is the same thing happening with these indexes. So that first orange line, you're seeing the S&P small cap index, the blue line being the S&P 500, and the red line being the NASDAQ 100. So those are tech stocks. Previously, they all were trading in a very tight correlation spread. That spread has opened up dramatically since then. So it's very interesting that the small side is starting to outpace the big side, which had not been the case previously. And so a lot of people are speculative that these pro-Trump policies are going to help kick off the smaller side of the businesses, and we're really starting to see that spread take off in some of these ETFs here on the smaller side as well, where we're seeing the IWD and the IWF. So this is the value in the IWF, or the orange line, starting to take off and outperform the growth side, which is something that switched over just very recently. And we look into the second graph here as we move over into about March. It jumped across where the blue line started to jump over. Previously, the growth was on top of the value, and the value now is starting to pick up, and that spread is growing and growing and growing. In the third chart, if we look more recently into past November, into December, January, we started to see that spread start to grow even more so and more so. This might be a time where the correlation is starting to freak out. It's getting a little chaotic, and if there's ever a moment in history, maybe in the past 7 years, where you needed to think about rebalancing, where you needed to think about, what are my bonds doing? What is my target date doing? What is my allocation doing in my 401k? I don't look at it that much. I'm not really a guy who is constantly rebalancing. This might be a time for you to take a peek at the markets. Why are they disconnecting? What areas are outperforming others? What's the outlook? What's the general consensus by the investing community, especially the institutional investors? Where are they headed? And how can I rebalance and ride that wave as well? If you have any questions, make sure to email us directly. You can go to the Contact Us page on financialtimetraveler.com, or you can tweet at me, you can Instagram me. I'm going to take it all into account. I'm going to answer each one of your questions, and we'll respond back to you at the end of the next podcast. Now let's move into the next section. I call this the keys to the city. Now, keys open doors, as you know, or as our man DJ Khaled said, I got the keys. All right, so let's get straight into housing and what's been going on in particularly the construction spending area. Now, this is a lagging indicator that we look at as economists to see how many homes are being built. Now, Bloomberg had previously discussed that we are at an extreme shortage of supply of new homes, as there are more new families being created than there are new homes being built. So we would expect to see construction spending going up. Now, it seems as though builders have been having a harder time securing loans to be able to build these homes that people need. And so when we look at this construction spending chart provided by Econoday, we see that these percentage points, as measured month over month or year over year changes, have been dropping dramatically. So going back to August of 2015, we see that spending reaching a point of almost 15%, the low point being in February 15th, getting down to that 6%, but more recently getting down to almost a 1% positive change, which is not much. But what I think is very interesting about this, one, it's starting to pick up steam. So if you read in this report a little bit, it's starting to turn higher getting into October with a 0.5% gain, a year-over-year rate gain of plus 3.4%. So that's going to move these bar charts a little bit higher. But what I thought was the most interesting quote was that residential spending showed October strength for both single-family and multifamily homes was speeding up added my emphasis there. With non-residential spending mostly slowing. So what does that mean? Commercial spending is slowing down. Single-family homes, multifamily homes are speeding up. So in talking about the open market, the REITs, the 401ks, where most of the dollars are in America, most money is invested in these pooled portfolios of housing assets. We're going to see that REITs are mostly holding commercial assets because they're more expensive, they're bigger, they're easier to fill up the portfolio, right? But what's going to happen with these private lenders, these private placements, these private securities that are able to go in and flip these single family homes, these multifamily homes, which might be a condo, which might be an apartment complex, they're going to be much more aggressive during this time. One, they're probably getting their money from private lenders, so they're not having the same problems with the banks that we're seeing with the big money guys. And two, they're going to have a lot easier time flipping it because the people who are buying it are able to secure low interest rate loans at a time where we're having very low interest rates. A beautiful time to buy a home. So it was very interesting to see all those things played out. We've been talking about this since August, and it seems as though the economic data is supporting it rolling into 2017. So that was very encouraging to see for you. If you have a REIT, expect for the price to go down as commercial assets are slowing, and that if you're able to invest in single family, multifamily, residential, you're probably going to have a surge in prices from the flipping that you've been doing previously. Not a great time to jump in, but we're definitely recognizing that if you've been in the space, you're going to be able to play off of that. So let's move into the next area, and that is we have a new president, and it's getting very interesting because there are some severe conflict of interest that I think is very important to me, that relates to me because I work in the investment advisory world. I work for Up Capital Management as an investment advisor representative, and there we have a lot of conflict of interest that we have to disclose. Now, we moved away from the broker-dealer business where we had conflicts of interest and selling mutual funds and annuities and things of that nature. Completely terminated that business. Fee-only fiduciary. I've had to talk with numerous attorneys and counselors about what does it mean, how do you disclose it, etc., etc. And for a president, I mean, this is the ultimate spotlight for a conflict of interest. So he has billions of dollars in his portfolio, and how is he going to hedge that? How is he going to protect it? How is he going to serve the American people and make sure that his businesses don't go bankrupt because he's leaving them in the hands of people who haven't been running them previously? Now, he did leave them to his two sons, and they have appointed it looks like an ethics committee advisor who they've hired. So that seems like it's just adding another layer of the conflict, where if you hire an independent ethics advisor, if you're able to hire and fire them and they know it, are they really going to provide you the most, or do they have any subconscious bias in providing you the most transparent report on that? They're not going to be able to talk about any of these dealings or business dealings together as father and sons. Very interesting. I think that right now, it would be speculative to see how it plays out. Yes, there are some red flags of people watching the watchdogs, and that's why we have our appointed people in the Congress and Senate and in the judicial branch to be able to make sure that our executive powers are being monitored. But it will be very interesting to see how it plays out for the rest of the year. I've heard more and more chatter up the ladder. Hey, that was a little accidental rhyme there. That we're going to see people weighing in more and more to make sure that there are no Trump business dealings that are taking money from foreign powers, because it's not only about money, it's also about influence, right? And so this is something that's very interesting that we will need to keep an eye on to make sure that America is coming first in everything that's happening in the government. Now, with us, pretty much with conflict of interest, we just have to disclose it. As long as you know about it, you're able to make your best choices about it, then you're good to go in the investment world. For the most part, don't quote me on that. And in the presidential section, I hope it would be the exact same thing. Full disclosure, although we don't have the tax returns, which makes it a bit harder for us to know exactly what we need to be keeping an eye on. Some of the more famous brand names, obviously, like Trump Tower, we can keep a watch on, but all the other LLCs and different shell corporations that we might not know about, it's harder to keep track of. So it'll be very interesting to see how this plays out. As a finance nerd, I think this is like the Super Bowl of watching, how these litigations are going to incur. So I will keep you up to date. If you're interested in that, shoot me a question. I am your crewneck sweater champion of the world, and I'm available on Twitter, Instagram. I also have an Outlook app on my phone, so you can send me an email if you have it. Find it on the website, financialtimetraveler.com. So let's move on from that hack into another one. This is a money hack. Now, there was a very cool report that came out in Science magazine Nautilus, which is not a Bob James record sampled by a lot of hip-hop guys. I'm going to drink my tea to that. So through this Nautilus magazine study, they thoroughly explain that there's this disconnect between our perception of our current and our future selves. It's really fascinating stuff. Basically, it's multiple test studies and, doing all these blind tests that they did, double-blind tests, have shown that the neural activity when we think of our future selves is more like thinking about a third person. And people aren't taking care of their third person self because they aren't thinking about themselves in the third person. I'm not thinking about, hey, how's Grandpa Nyle doing? And, every time somebody talks about themselves in the third person, usually sports athletes, we look at them like they're crazy people, but maybe they're onto something. Maybe they're taking care of themselves better than everybody else because they're hacking their peripheral conscious to be able to say, hey, I am another person and I have to take care of that third person. So what this study shows is that we are not taking care of ourselves when we don't think about ourselves in the third person. We're not saving enough. We're not taking care of our bodies enough. It's very interesting. So the hack that they found is to be very future conscious and making sure that our future self feels like someone else, that you have a relationship with this person and that you're able to reverse engineer the goals of where you see that person and how you're going to get to that point in your life when you actually arrive at that end note. Now, it's very interesting that this kind of, if we had a Venn diagram of Financial Time Traveler and this Nautilus study, there would be a lot of crossover because we think about procrastination being that you're valuing a future date less than today and that we need to value every date at the same value amount so that we can reach our goals at a rate that is faster than if we procrastinate it out. So a lot of the things that people procrastinate, they say, oh, I have this task today, I'm going to put it on a future date because that future date has less value. Our time value and our time preference goes down as we see further and further out down the timeline. And so when that happens, that future date comes, we say, oh boy, today is just as important as it was 3 months ago, so I'm going to kick this same task down the road, etc., repeat. Now with this study, it's saying if you're able to see yourself in a third person, you can help diminish that time value, that myopic time preference that we have, and be able to expand it, to be able to achieve more, to have more patience today so that when we reach that future date, we can be impatient, we can be filthy rich, we can be super buff, we can have all the friends that we wanted, we can be on cruises with yachts and planes or whatever we want. We can be in the middle of the Himalayas, doing meditation routines, totally up to you, but if you want to get there, you got to reverse engineer it. And this money hack is very interesting that it backs everything that we've been claiming here at Financial Time Traveler, and it helps us to be able to understand where we are in the future. So if you want to be somewhere in 30 years, try to imagine yourself there. What clothes you're wearing? How long is your facial hair? Do you have any facial hair? Do you not want any facial hair? Do you have glasses? Do you not have glasses? All that stuff will help you visualize who you are and then be able to work backwards. Okay, how am I going to become that person? So very interesting stuff. And this is going to move on to our time capsule. So did you know that we have an invisible American? Yes.
I'm the invisible man. I shake your hand, but you don't feel it.
He's everywhere. All right, it's a little bit corny, but it gets the point across. So there was this great study on Gallup.com, and this was done by Jim Clifton, who's the CEO and founder of Gallup, and he felt like there is this invisible American that is not being reported because we're seeing all these positive economic data. Unemployment is at the lowest rate. The Federal Reserve has a dual mandate to watch inflation and to watch employment rates. And so he's seeing this middle class shrink. And so the Americans who have polled and said that they are in the middle class or upper middle class has dropped significantly. So in 2000 to 2008, we had a 61% reporting. And in 2015, it dropped by 10 percentage points down to 51%. Now, what he's saying is in the invisible American is that the unemployment rate has been dropping, yes, but the amount people are making is dropping as well due to surveys like this. So let's take a look at this chart here. So we're seeing the upper middle class as low as the upper middle class shrink, the lower class grow. And what he's saying is what happens with this 61% that 10% that nobody's reporting on. So there's 250 million U.S. adults that are working. So 25 million people whose economic lives has crashed, basically. They've dropped out of the middle class, and they are now in the lower class. They're not reported in the official U.S. unemployment rate. And so that can go, you could be going from a $65,000 a year job all the way down to a $28,000 a year job. And it's basically not reported. And in fact, it's reported the opposite. It's reported that this is good news. And so my takeaway from it is that we need to be very careful that we're looking at all the data, especially in the mainstream media, which unfortunately, fortunately, I am not involved in, and that's what led you here. But the mainstream media basically reports that this is a positive thing, but if we take a closer look, it seems that the middle class is shrinking at a significant rate, and that the amount of money that they're grossing and netting every year is shrinking as well. So we need to be able to empower people, to give them the tools necessary to be able to look around and see what's happening around them, to build wealth consistently. And that's what we do at Financial Time Traveler. If you have any questions, make sure to go to the contact page on financialtimetraveler.com. You can hit me up on Instagram, Twitter. I will take all your questions and address them in the next podcast. So let's move on to the next segment, and this is called 401k, because we got questions. 401k. All right, so we talked about correlation chaos, the correlation chaotic, the correlation problems that we're having in the world. There's some correlation issues. And what's going to happen is that the majority of funds held in 401ks, majority of Americans that invest are invested in 401ks. The majority of Americans are not out going to E-Trade. They're not going to TD Ameritrade. They're not going to all these different brokerage firms and signing up and investing and buying cash positions. Not happening. Majority of people who invest are investing through their employer-sponsored retirement plan. So we're talking about a 401k. Now, the majority of those people are invested in their default investment, which would be a lifestyle fund, which would be an asset allocation fund. Now, you hear the champions of these funds would be like a Ramit Sethi, very big champion of the lifestyle funds. Another one would be maybe a Dave Ramsey. You've heard how I felt about him. If you want to go back a couple episodes, do that, figure it out, and then come back here. Make sure you press pause, and we'll see you when you get back. But what I'm getting at is that the majority of Americans, as well as the figureheads in the personal finance space, champion these funds. Now we're seeing a big turnover in the markets. We're seeing the bonds get suppressed in prices. We're seeing equities starting to take off. We're seeing this correlation chaos happen where certain turnovers in the market that do not happen very often are happening very fast, and cycles that used to take a year are now happening in days and weeks. And so it's very important to consider. Now with the target date fund, the way that they allocate is that the lower you are, let's say a target date, you're in target date 2015, you're going to have more bonds and less stocks, right? And the farther you go out, you're going to have more equities and less bonds. Well, what happens to people who think that they have less equities than they do or more equities than they don't is that in the beginning years, you think, okay, I'm retiring in 2015. That means I'm out. I'm like 100% safe. Not true. They still have to layer in a bunch of alpha or equities into there because you still have 20, 30, 40 years to live after you retire. And same thing farther out, you might think, okay, I have zero bonds, and that's not true. They've actually added bonds into the 2045s, the 2040s, etc., to make sure that you level those storms as we're going out. This is all outlined on the financialtimetraveler.com. We have Do You Know Your Target Date? If you just go to our search bar with the automation in it, you'll be able to find this article very closely. But it's very important to calculate out when we see these market turnovers, is the target date going to participate in the extra added performance that's going on in the market? And it actually might be a net negative if you're in these target dates. So the 401ks, the majority of Americans, if we take this back to a macro view, the majority of Americans that are sitting in these default funds, they might see a negative return when the market is taking off. So you might have these calls to advisors, which I get all the time. Hey, how come the market's doing this and my account isn't? Well, that's because what's inside of your fund, the funds of funds. And so we have lifestyle funds, which are like asset allocation, the conservative moderate growth, and then you have the target dates. Completely different. One's based on risk tolerance. You might be retiring in 40 years, but you're a conservative guy and you're sitting in this conservative fund. You're going to next year is going to be tough for you. It might tank for you because you have so many bonds that are not going to perform well. Or, if you're in the lifestyle, you might be picking a year. if you're retiring this year but you want more equities, you might have to move up a couple years. If you were previously in the 2015, you might want to rebalance farther out, even though you're not going to retire in 2030. It'll just help hedge the market environment coming up in 2017. So let's move on to the next category, my favorite category, which is the reader response. Talk to him.
Let's get it on. You don't give a what, you don't give a what.
All right, so I just want to say I'm very humbled that people even watch me. For a while, I felt like I was talking to myself in the closet, which I do anyways, but don't judge me. But now I have people who are commenting back, so that's cool. So I'm going to shout out to you and say thank you so much. So let's start off with Anthony H, who follows us on or subscribes to us on YouTube. Thank you so much, Anthony. He said a couple things, but this one I like so much. He said, keep them coming. And our social media responder said, thanks. We don't plan on stopping anytime soon. That was actually Nick. It wasn't me. I swear to you. Say what's up, Nick. Hi. He's over there. I promise. All right, so our next one, we have Adam S., who watched the video about Dave Ramsey, problem with Dave Ramsey 401ks and financial freedom, or the use of the word. And he tried to tear me to shreds. So he called me young guy, and then he called me Nyle, and then he called me young guy again. But let's read it out loud. Here's the link the young guy is referring to, so you can read it yourself, which there is the link for everybody. It was also in the description. And then at 5:45, Nyle talks about reporting a report stating 68% of Americans don't have $1,000 saved. 6:25, young guy asks if Dave Ramsey has had an impact on the macro numbers of Americans because they don't have any money in savings. Apparently Nyle, I'm Nyle again, doesn't know the very first thing Dave Ramsey tells you to do is put $1,000 into savings, which we actually did know. Typically, you want to know what you're talking about before you start talking to avoid sounding ill-informed. Definitely down with that philosophy. However, I'm probably going to sound ill-informed. You know, when I talk a lot of times, I talk out of the side of my mouth. It's not my fault. It's supposed to be entertainment, Adam S. Are you saying it is Dave's fault the majority of people don't listen to his show or read his books? No. 1420, Nyle struggles to remember ELP or endorse local providers, complaining that Dave Ramsey declined to not let him be a part of it. A part being one word. Apparently, he doesn't know that the investment referral program is called SmartVestor, and ELPs do not provide investment advice. Again, the whole know what you're talking about before you start talking. Entertaining show, though. I like Anton. He seems pragmatic. Well, we had to respond to Adam because there was a lot of things off base here, so I'm going to get back to you, Adam S. I said to clarify, Nyle has never stated Dave Ramsey is at fault for the majority of Americans having difficulty savings. Never said that. However, very much so questioning Ramsey's effectiveness. The young man has a strong sense of skepticism about Ramsey when he is personally referring millions of dollars in assets every year to commission-based brokers who have been shown, with that report that he linked to cost their clients 1% more than fiduciary advisors in fees on average. So that is a fair and valid stance to have. Stating otherwise is a detraction at best. Now, Dave Ramsey's organization did not exclusively decline me. All fiduciary advisors are declined on their platform, which I thought was an issue. All of that is discussed during the show. Furthermore, our show is curated in a way that is off the cuff and 99% improvised. We are not professional broadcasters, producers, or journalists. We only try our best to pretend. It's a commonplace for mistakes to occur in this improv type format, which is why shows such as PTI on ESPN, etc., etc., etc. So basically, Adam didn't like me. He's probably on the Smart Investors platform, and I was like, hey man, I totally agree. You should probably, watch it before you comment. Same thing, right back at you, Adam.
I'm gonna go here, my bad. It happens. Anyway.
Now, the next one, we had a market update on, back on December 12th. And we had a comment. This guy hit us on Facebook. Now, Facebook's interesting because we do sponsor posts, and mostly to just reach a new audience, right? I try to get a new audience, a new readership, people who might be interested in this information that weren't there before. And sometimes we get off-the-wall comments because people just read the headline and they don't go much further, right? So this guy just commented a picture of a stamp from 1969 of a discount to buy a Roadrunner. It looks like it's $138 off. I'm sorry, $143 off. plus this ad worth $50 off additional to purchase the Roadrunner, which I thought was a cool comment, except I had no idea what the relevance to the post was. So actually I tracked him down, and I was curious, who is this guy? Is this a robot? Pretty much there's been notorious on Facebook for click farms, where if you're a sponsor and you're paying for a post, there's these click farms out there that'll fulfill the order for Facebook, and you're basically paying for nothing. So I sometimes do the due diligence. I click through, I figure out who's actually liking to make sure that they're real people. Good news is he was a real person. Bad news is he didn't leave the cool comment on our page, but he did post that exact same picture on his page, and he had a pretty cool breakdown of what he meant by the image. So, and by tracking him down that way, I was able to figure out what in the world he was talking about. So let's see if I can get back to it here, because I had it on my phone and I wasn't able to print it. Come on. We're gonna have to play some Jeopardy hold music right here. Come on. So close. My guts are moving. I hate the way that. So, alright everybody, I found the comment. It was only 10 seconds. Swear. Put that on. Alright, Patrick Anthony Ockander has some other suspect quotes, but this one is a cool post. It says, in 1969, $41 would buy yourself an ounce of gold. At $26.95, that would be equivalent to about 68 ounces of gold. $27,000 gets you a base Dodge Challenger. Today, gold is $11.80 an ounce, about 23 ounces of gold. If you had to pay for yesterday's 69 Dodge Roadrunner with today's gold, you'd pay $80,240. Whereas if you paid for today's Challenger with yesterday's gold, you'd pay $920. Take it one step further, if you had saved your $2,700 from 1969 and put it in a shoebox till today, if it survived, you'd still have $2,700. But if you'd bought 68 ounces of gold, you could sell it and have $80,000, $240, or more if you bought coins, which go up in value based on collectability. By the way, a mint 69 Roadrunner would get you about $119,000 today, or 100 ounces of gold. And to that, I say, well, what if you bought 100, just 100 shares of Walmart when they IPO'd in 1970? So that was $16.50 a share, $100 a share, $1650, so $1,650 on the money, and you would be valued at an amount of about $12 million today, adjusted for inflation. Now remember, this guy, Patrick, he didn't adjust any of his numbers for inflation. Now I'm adjusting the returns for inflation to get you back $12 million off of $1,650. Not only that, but you would have had dividend payments of $400,000 adjusted for inflation. So once again, gold sucks. Equities win. We'll see you next time. If you have any questions, make sure to @ me. I'm on Instagram, NYLE to the BAYER, as well on Twitter, Facebook, wherever there's social media, your boy is there. You can get at me. I'm probably wearing a crew neck sweater because I am the undisputed crew neck sweater champion of the world. Also the president of the Suburban Dad Club. You can find me anywhere that tube socks are being sold. See you next time. Love you guys. Everybody, this is Nyle from Financial Time Traveler, here to give you a response video to all the comments we got for episode 17 of the Financial Time Travelers podcast. That podcast was titled, Gold is the Worst Investment. It stands for specific. Now this means that your goals should not be vague. Something that I want to get my name out more. If you're an artist and musician, that is not a goal. That's an ambition, entirely different. A goal looks something like I want to make
11, 10, 9, ignition sequence start. 6, 5, 4, 3, 2, 1.
The Eagle has landed. Roger, we copy you.